you can see, if you can make it out on the screen, Mark Carney speaking from the Mansion House speech live at the moment. And we've just seen some movement in the pound, so let's just cover that first and foremost. We had a little, well, let's just explain the move as it's come out. So Carney's speech coming alongside the UK Chancellor Philip Hammond. This is the delayed Mansion House speech, which was supposed to have been delivered last week, but they've been delivering it this morning, due to some of the events that occurred last week, notably the fire in West London. So what we've had, not so much the Chancellor, more the Governor from the Bank of England. His main comment was that now is not the time to hike interest rates given anemic wage growth and mixed signals in consumer spending. So this is kind of the headlines here. Carney rejecting the push for higher rates in delayed Mansion House speech. And as such then, looking at the pound, an immediate spike lower was seen on the back of that comment. This of course comes after what had been a surprisingly hawkish development in the Bank of England's vote split last week, which saw 3 members, which is the most hawkish it's been in a very long time. I believe it's pretty much a decade really, since really the financial crisis or the onset of that period. Saunders, Ian McCafferty and Christine Forbes were the 3 hawks, so to me it's not that surprising to hear the Governor, who is speaking on balance for the majority at this point, dismissing the push for higher rates. But I guess his wording is pretty definitive and clear, hence the reason we've had such an aggressive spike lower in cable here. Again, his comments were that now's not the time to hike given anemic wage growth and mixed signals in consumer spending. So that obviously divergence between increasing inflation, the highest now since the summer of 2013, comparative to, as he describes, anemic wage growth, continuing to give mixed signals on consumer spending, which could be detrimental to the UK outlook and growth potential going forward. So the way that this move also occurred here, I would have been a little bit hesitant. It happened very quickly. I guess there would have been an opportunity for a classic, looking at that previous low that was in play from the 15th. It came after the spike up to 127.28. Before then it pushed down to just seeing now 127.04. But again, as I say, pushing beyond this S2, whether it's got the legs to do that, we've already moved from 127.80, so it's a decent 70 pip move, which I'd say is pretty big actually, given these comments. They are dovish, no doubt, but probably just exacerbated somewhat by the technical break as well of that low on the 15th, probably helping accentuate that move to the downside. Obviously any break below here, if we continually move lower, then there's some key levels on the downside, that really being around 126.76. This would be the post-hung Parliament lows that would be eyeing, which would be quite critical then for the fate of sterling in the near term, given that these Brexit talks are also now underway and there's still some looming uncertainty over the piecing together of a cohesive government going into the Queen's speech, which of course is tomorrow, when the government will look to outlay their plans for the upcoming year. So just as I'm delivering this briefing, I'm sure a lot of you will be keeping an eye on that. I don't blame you. It's a pretty decent move to start the morning off. But having come down to a 70 pip move at its extremity down at 127.04 could be the limit of what you're going to see out of just that one news snippet on its own. But definitely worth keeping an eye on should we break below 127 handle, eyeing then the hung Parliament lows to the downside. Again, this is when, of course, when you're preparing as a new trader, you have to be aware of the calendar and the fundamental events that are occurring that morning. We already knew the Mansion House speech was happening this morning. If you were listening intently enough to the squawk, you would have been prepared for the commentary coming out. You know, this is a classic case of when the fundamentals have overweighed anything else at this point in time, and it's forced the price lower. So don't get caught off guard. This is when your preparation, as per your first thing you do in the mornings, really has to be key. Okay, let's have a look at a couple of other things on the charts. Firstly, obviously US equities have been particularly interesting. We managed to get above that key double top that have formed from the 9th of June and the 14th. A break of that, as you can see, which was around the Wall Street Open. We needed that kind of flush of volume at the Wall Street Open to really push break of that technical level. Again, an extension and then above R2 on the day to finish out. Again, record high territories. I did see a snippet headline. It's one of the best days as well we saw in the tech sector in some time. Amazon obviously was a bit of a focal point given that deal that they've done with that near $15 billion deal for Whole Foods that materialized at the end of last week. And some of the nervousness that was already apparent about 2 weeks ago. We had that late sell-off. I think this was back on the, well, if we go back on the chart, it really tells the story. In the S&P, there's even more evident in the Nasdaq, obviously more tech sensitive. But this was that moment where the Nasdaq really got hit and the S&P fell in sympathy. This was that talk of a sector rotation out of the overvalued tech sector into possibly some more defensive names as we trade longer term up at these quite elevated levels in US equities. But now here we are, more than reversed that entire move. So really impressive from a US equity standpoint. Well, this is the Nasdaq. And the Nasdaq technically at a fairly interesting level as well here. This was the sell-off, so in terms of the Nasdaq recouping that loss, it's still got some way to go. I guess from that entire sell-off, we've retraced almost 50% of the move already from that eventual low that was seen on the Monday after the Friday sell-off, because it was a kind of 2-day negative sentiment play with that tech move. But as we start to recover, first point of call, I guess, we'll be looking for any test up at this 57.89 in the Nasdaq future. That will probably be key then as to whether or not we can then see a concerted push back up to probably, not surprising if we were to move all the way back up towards territory of R2, whether that happens intraday, possibly not, but if we can get back above that technically significant level of 57.89 and breach back above 5800, then no doubt, I'm sure, if these other indices like the Dow and the S&P continue to track to record territory, no reason why the Nasdaq won't continue to rebound as well. Consequently, looking at the DAX this morning, we are positive. Quite interesting technically here, because if we look at where we're trading at the moment, obviously you can see we're trading the SEP contract, so fairly illiquid when we go back to May. But just looking in the near term, fairly interesting technical peak at the afternoon of the 14th. We gapped up slightly this morning following another kind of positive session in the US. The S&P was up 0.8%, the Dow 0.6%, the Nasdaq up 1.57%. These are in itself fairly incremental changes, but going off the kind of fairly narrow ranges that we've had for the closes on Wall Street, these are pretty aggressive upside closes for the US indices. Hence we gapped up in the European markets this morning in the DAX. Quite interestingly, found some resistance at R1. Now we've come back to find support at that previous 14th high, and that's also quite close to those lows, or excuse me, the highs that we were retesting, but failed to breach late in the European session and also the US session just before the close. So I'll be keeping an eye on that level as well in the DAX this morning at 12,915. It has held up prices thus far. Just looking at cable then, you can see, as we would have thought, the news at hand kind of has had its impact. it looks like probably that 2704 S2 is the extremity of that move. From a price movement point of view, this is often quite usual in what you see in a fast money move. When I say fast money, this is the market, let's say when you're trading on your ladder, you're hitting it at market, trying to take advantage of the momentum on the short-term price movement. And then quite typically people will be looking for the next level to take that trade off, and quite typically the daily pivots, of which the majority of the market will be looking for, would be a good exit point where a lot of people would have got out of that quick fast money move. Hence it's so kind of transparent, the tick, or the move to the tick, so to speak. Starting to see a slight bit of recovery. I'd imagine the price might come back up to 127.28 as a bit of resistance possibly now. Be interested to see what it's like when it comes back up to that point. Again, dovish commentary, but not wholly unexpected, I would say. The reason for the aggressive move is because it comes in the context of a more aggressive or more hawkish tone that was issued from the Bank of England, and this more outright dovish. Okay, a few other headlines to be aware of. This being a review, if you like, of the first day of officially Brexit talks getting underway. So both heads of each individual party, Barnier from Europe and Davis from Britain, getting talks underway. And a lot of the headlines have been reading that despite all the tough talk from David Davis that it's going to be the toughest summer ever of negotiation, he's conceded within one day. And i.e. that being that the two sides agreed to prioritise negotiations on Britain's exit bill and a settlement on rights of EU citizens living in the UK and Britons on the continent. And so essentially Britain saying that they agree with Europe that they need to talk on their divorce proceedings before then we can have more constructive talks thereafter. And again, if you remember rightly, this was when Britain was saying we even 1 billion euros would be a lot of money, and Europe saying, well, you need to settle a divorce bill of some 100 billion. So obviously a great divide at the moment of where the two parties stand in their view. But I'd say the one thing that's become more apparent, particularly with the weak government mandate that we now have, given the minority government of the Conservatives, is that the negotiating hand has weakened as far as the UK is concerned. And so I would say unsurprising that the concession has been made already at David Davis. Kind of, if you've been watching these briefings over the last few months, I think it's I think ultimately Britain has absolutely no choice but to make severe concessions in order to secure a transitional agreement to discuss the terms of Brexit beyond the agreed 2-year horizon of what Article 50 would stipulate, just because of the legal complexity and the time that would be needed for then the discussions to take place, it to be ratified across both our own parliament as well as all of the individual European parliaments to sign it off. I think it's going to take way more than 2 years to get Brexit done. And so it makes sense then that in order to get that transitional agreement, we will have to pay for the right to have it, which is this settling of this divorce bill. What figure that will be is obviously an unknown quantity at this point, but one would imagine when someone starts at 1 and 100, you tend to converge into the middle. So something to be monitoring going forward. An interesting graphic that I saw this morning, if I just make my screen bigger. This was from Barclays. This is a guide to EU-UK negotiations. We're looking at 3 different kind of situations here: an orderly Brexit, an extension, and the kind of worst case scenario, a crash. And then the final outcomes on the far right: soft Brexit, hard Brexit, extension, and a crash Brexit. And this is basically looking through each individual phase, going through the various quarters of each year until the dotted line here on the red, which is the end of Q1 of 2019, which of course is the deadline then for when we are as per the formality of Article 50 of the Lisbon Treaty, due to then leave the EU. This then period here would be the transitional period if we were to then to go on to secure it. A soft Brexit would entail then the UK leaves the single market but is able to establish an enhanced partnership with the EU. The deviation from the status quo would likely be small and the economic impact still negative but largely contained. What's looking more, or I should say less likely, as a hard Brexit, that would be the UK leaves the single market but is not able to establish a strong partnership with the EU. The negative impact is magnified by material business adjustments over a short time frame. The worst case scenario, if the negotiation process is unsuccessful, the UK will leave without a deal and face a legal void. Trades in goods and services would fall back to WTO rules, but innovative solutions would need to be found for all other areas. Economic consequences would be maximum and disruptive. In terms of kind of the way to navigate comments, one thing to understand about these talks is timing wise we're expecting 1 week of negotiations per month, and in between those weeks consultations and technical works will go on behind the scenes. So David Davis and Michel Barnier will meet for 1 week every month, and then each party will go back to their own respective camps to discuss technical talks thereafter, before then re-meeting again the following month. One interesting thing is, obviously you've got the Queen's speech tomorrow, where we'll hear more insight as to the government's plan in the UK. But then you'll also have the EU leaders, which are meeting on Thursday and Friday. I would imagine then the weekend's press could be quite interesting to see what they have to say on these initial discussions. But much is negotiation. You normally start off, I would say, with pleasantries. That's kind of the normal business practice. I would say once we get into a few weeks of this negotiation phase, it should then start to heat up a little bit, and we'll get a better sense of how the land really lies and how much of a concession the UK is willing to make, or how aggressive in these negotiations the EU is willing to be. I'd say it's probably the way I would look at it at this point. But at this point in time, I'd say it's all smiles and handshakes. The one interesting thing here is that obviously we've already, after day one, made the concession that we will look to settle this divorce bill, which is quite a significant change in proceedings, so to speak. Okay, a few other things, just so you're aware on the headlines. For the Aussie currency, Aussie's not moved a great deal on the back of it, but you did have the RBA minutes overnight reiterating concerns in the minutes of the June meeting. Australia's central bank kept its focus on employment and housing markets even as signs emerge of improvements in both. So kind of the status quo, I would say, in regards to the RBA. Not really a great deal to speak of with that event. Looking at the calendar for today, there is, again, fairly quiet. There's nothing really during the day too much to excite. You've got in the afternoon the current account from the US, and that's pretty much it. I would say Eurozone current account and the US version of the same data set. Very rarely does it move the market. I'd probably classify this down at tier 2 if not tier 3 data in terms of its ability to move financial markets. Later on in the evening, obviously you'll have to wait for the API crude oil inventories. They're not coming out as per usual time until after 9:30. Speakers though, it is obviously a bit more interesting. Mark Carney is still speaking. If you can see it up on the screen, he's kind of reading the opening speech still. If he does go on to take any questions, obviously you'd need to be monitoring that very closely from a sterling point of view. But elsewhere this afternoon, you've got Fed's Fisher, a neutral stance and voter. You've also got Rosengren, non-voter, speaking on financial stability. ECB's Coer speaking in Frankfurt, text available. And Fed's Kaplan, a soft hawk, speaking on policy outlook. So A couple things to keep an eye on. I'd say probably Fisher, who is the deputy on the Fed under Janet Yellen, tends to be fairly closely aligned with his policy thinking with the Fed chair. So I'd say that's probably the one to look out for. But in the context of having heard directly from Yellen herself in the press conference and summary of economic projections just last week, I wouldn't be expecting too much here from Fed speakers. I think she, all in all, navigated that meeting fairly well in terms of communicating their intention that the Fed have for the rest of this year to hike rates at least one more time. This brings me about, though, to finish off about central bank speakers. You probably read quite a bit yesterday about the replacement for Christine Forbes. One of the main reasons why the pounds had quite a severe reaction to the dovish comment from Mark Carney this morning is because of the hawkish comments, in particular from the likes of Christine Forbes. The one thing important to remember about her is, although she voted for a hike that we saw in the minutes last week, she is in fact leaving at the end of this month. Her term is up and she is being replaced, we heard yesterday, by this lady Silvana Tenreiro, or Tenreiro. I'm sure we'll get the correct pronunciation of that when she starts to speak more often. But obviously question marks will be, what is her stance? Because she is coming in as a replacement for what has been, for the last year at least, and certainly the last few months since Christine Forbes first started to move away from the pack and has been calling for a rate hike for a number of consecutive months. The question mark is, does this new lady represent the same type of monetary policy view? So there's really two ways to look at this. One is, what is her background? So she's currently a professor at the London School of Economics and has been for 12 years. Her other jobs, if you like, have been as an external monetary policy committee member. So the exact same kind of role she'll be fulfilling at the Bank of England. However, instead of it being the BOE, it was the Bank of Mauritius. Slightly elevating the game then in terms of stepping into the fray at the Bank of England, particularly at this juncture where we are at the moment. And then she's also been an economist at the Federal Reserve Bank of Boston, Harvard University PhD in economics, so comes from a highly, I guess, theoretical background rather than from business, so to speak. But pretty strong background. The other way to look at this, I guess, to ascertain then what is her view on financial markets, to have a better insight as to where she sits on the hawk-dove scale. Although we don't know what it is precisely, she has published an academic paper arguing the impact of monetary policy as being asymmetric, which would put her closer to the core of the MPC thinking rather than being an outlying hawk like Christine Forbes would be. That would mean then, once she comes in, the overall composition and balance might move slightly to being more dovish than what it currently sits at the moment. But when she first delivers a speech, I would imagine this won't happen until she takes the seat starting in July. The first comments and commentary will be key to ascertain with more confidence what that view actually is. Okay, that's pretty much it for your briefing this morning then. So not a great deal on the calendar for today, but as per yesterday, I'm still interested to see how equities perform. We've had that last little push up to record high territory. What does tend to be a bit of a pattern here is you tend to get a little bit of a phase of consolidation, I would say, after you've breached new all-time highs. So if I'm looking at the S&P in that kind of way, then 24.51 upside and probably pivot downside just above then those previous double top which we breached yesterday around 24.43, 44 could be quite interesting to play in that regard, given the lack of real economic data. The DAX as well held up by 12,915 for the moment, and again playing a range of between that level and R1. Any break though of 12,915, I'm sure we'll start to see the DAX liven up if that materialized. The cable we've spoken about. Looking at the euro, that's at a fairly interesting point as well, because we've got close to the previous low that we had the end of last week. So this is kind of Thursday, Friday levels of support, which is really around this 111.93 mark, which I'd be watching quite closely. Obviously, if we break that, you've got the low that was seen on the 15th at 11.87, and then targeting below there would be then, I guess, on the dailies S1, which is more around that 111.79, which was also the low that was seen on the 30th. So some quite obvious downside levels to keep an eye on in the euro currency. On the flip side, if we're moving higher, pivot looks pretty good, given you've got that previous low as well that was seen on the 9th in the euro-dollar pair. So any recovery up to pivot, that level also comes in at 112.25, which is 2 pips just above pivot level as well. Okay, coming up to 9 o'clock then. Gonna leave it at that. Any questions, feel free to pop them in the chat room. For any of the live guys, Vas is out of the office this morning. He will be back this afternoon, so you have Philippe steering the ship for the live guys for this morning. Any questions, please feel free to put them his way. Okay, thank you very much and have a good day.